Hey there, everyone. Happy Tuesday, December 3rd. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a foggy but gorgeously, deliciously cold but kind of sunny Redmond, Washington. We've got all the feels here weather-wise in Redmond. It's actually quite foggy because it's so cold here, but hopefully that is temporary because we're not used to sub-freezing conditions in these here parts. Looking at the markets today, some choppy action, I would say overall. For the S&P, this is much ado about nothing. The S&P finishing the day right around 60.50. As we look at the charts, we'll talk about while the S&P remained relatively stable. One of the important takeaways, maybe two, as I'm reviewing the action today. Number one, sector's a lot weaker than you'd expect. So the S&P's flat. You kind of naturally assume it's probably a 50-50 split between sectors up and down. That would make some logical sense, I guess. Not the case. Only 2 of the 11 S&P sectors actually finished in the green today. Most of them finished down for the day. Other thing I would note would be the breadth was a lot weaker than expected. Again, so for flat price action in the benchmarks, sectors much more negative, breadth much more negative, right? It's almost a 2-to-1 ratio of stocks down versus up, depending on what index we're breaking down. So this is one of those not that bad of a day kind of days. If you look at the major index, if you look at the S&P and see that it sort of finished where it started, you look at other conditions, sort of the underneath the hood variety, right? Looking at sector movements, looking at breadth, not nearly as constructive. With that in mind, let's go right to our market recap and look at what the charts can tell us. Starting with the dashboard here, we call the market overview. We see the S&P finishing just slightly, just a couple points above Monday's close. So we finished around 60.50, just slightly below that. The Dow was actually down slightly, 0.2%. The Nasdaq Composite up slightly, about 0.4%. Mid caps and small caps both down. And the S&P 600 small cap index down about 0.75%. The VIX moving a bit lower. We have a chart of the VIX here in a few moments. I just talked earlier today, recorded an episode for the podcast with Russell Rhodes, who is a author and professor. He wrote a book called The VIX Trader's Handbook, which some of you may have read. Had a chance to chat with him, ask him questions about the VIX, about volatility, what sort of things to look for right about now. It was a fascinating conversation. I had a lot of fun asking him a lot of good questions, derived from my own reading of his book. So hopefully that'll be out later today, maybe tomorrow morning. So keep an eye on our YouTube channel. The podcast is called Market Misbehavior. Latest episode will be out here very, very shortly. Have some other interviews lined up for later this week and over the next couple of weeks. A lot of fun conversations to share with you. And I hope that it enhances your understanding of these markets, bringing you some different perspectives from a lot of different market experts. Looking at interest rates, we moved higher today slightly. Shout out to my friends at Forex Analytics, Blake Morrow, Dale Pinkert. I joined their pre-open show, which is quite early for here in Seattle, but we made it. It's about a 5:30 a.m. kickoff when we talk, but a lot of fun. Dale is just one of the good guys, really seasoned trader, seasoned market analyst, and we talked a little bit about the interest rate environment from a technical perspective. Talked about Fed rate cuts potentially here in the December meeting and onward. So I hope you're able to enjoy our conversation there. But for today, rates moving higher. The 10-year yield finished today just below 4.25%. 5-year point a little lower, around 4.1%. The long end of the curve is higher, around 4.4%. The dollar index, no real change from yesterday. The UUP almost identical to Monday's close. Commodities actually having a decent up day here. Gold was up slightly, about 0.2%, but silver prices up about 1.8%. Crude oil prices moving higher. Natural gas came down, but most of the commodity space was actually higher today, which is a nice reversal to some of the weakness we've experienced here recently. Bitcoin continuing to sort of, back and fill below that 100,000 level that it tested here in recent weeks. We're currently trading just below 96,000 on Bitcoin. Ether prices just above 3,600. XRP, which had a monster up day yesterday, chopping around here quite a bit and finishing about 4.5% lower. You can see kind of mixed results for the rest of the cryptocurrency space. All right, looking at the 11 S&P sectors, as I mentioned in my introductory comments, this is one of those days where I think it's super valuable to look underneath the hood. There's a reason why our show starts with the S&P and the Nasdaq, and mid caps and small caps, kind of like the major indexes. Then we look at other asset classes. Then we look at sectors. Then we look at breadth. Then we look at individual stocks. And the reason why we do it is because that's how I've done my process for years, learning from those that have come before me that talk to me about going large to small, macro to micro, big picture to small picture. It's a great way to sort of understand the broader forest and then focus in on trees, focus in on a branch, focus in on a particular leaf. And that's how you get, large to small. That's how you understand the overall environment before you start to focus in on individual things. And this is one of those times when I feel like I'm very thankful about the fact that we have the tools we do to understand that next level lower. Because if you just look at the S&P, it has a particular, kind of flat day, seems like kind of an unchanged kind of yawner of a day. But if you look underneath the hood, you can see the conditions were actually a lot different than you might expect. Only 2 of the 11 S&P sectors finished higher, and they're 2 of the biggest. Communication services up 0.8%. We'll talk about stocks like Meta making new all-time highs today, finally pushing above $600 a share. We've talked about that being an alert. I literally had that alert set this morning. My cell phone dinged with the alert from stock charts that we had indeed finally broken above that resistance, that ceiling, following Apple's breakout over the last week. Technology, number 2, up about 1/3% as well. Everything else was flat to down, right? On the downside, utilities, financials, and industrials are worst performers. Those were down from about 0.6 to 0.9% below Monday's close. I did want to highlight just in terms of the breadth conditions, right? Another one of those where you see the S&P flat. You always, in my opinion, you always want to look at breadth conditions, right? Particularly advancers versus decliners, I think is a good starting point just to see what happened to sort of the overall group of stocks, right? The benchmark was flat, but you can see on about a 2-to-1 ratio, more stocks were down than up, and it wasn't even close, right? So if you look at the S&P 500, about 69% down, 30% higher. So while this felt like a flat sort of limited action kind of day, there was plenty of action with a lot of stocks actually getting some deterioration. If you look at some of the leading stocks on the downside, it's actually in some of those growthy sectors. Things like semiconductors got dinged pretty good. Seagate, which is not semiconductors, but still in the technology sector, down over 4%. So the cruise lines, which have had pretty good runs, struggling as well. Looking at the mega cap growth names that we call the Magnificent Seven and Friends, I highlighted Meta breaking above 600, closed just below 614, and that's 3.5% higher. Amazon, Apple having decent days as well, both up about 1.3%. Only 2 of these down. Tesla was down 1.6%. Tesla has become a volatile name. I mean, it's always had some, sort of a differentiated return profile is how that's sort of the corporate speak from working at a big money manager that I would use to describe Tesla. That is a very nice and eloquent way of saying it's been a choppy, sloppy chart. And it's kind of all over the place, and it's not really doing the things that other things are doing. So Tesla today down 1.6%, while other things in this group at least were doing well. And Alphabet flat, right? Alphabet is actually not it's not a bad chart, right? It's not one of those ugly charts, but it's not a great chart anymore, right? It's sort of it's a pair of twos, as Carter Worth, who I used to see very, very often in my Fidelity days, used to say, a pair of twos, like not a bad chart, but really, are you that excited about owning it right here? Probably not. All right, let's continue on looking at the MarketCarpet, the heat map visualization. This is a way to just, answer 3 questions. Number 1, just get a sense of the overall environment, looking at the sort of colors represented on this quilt that we're looking at. Number 2, look at the big dogs, the biggest names with the largest market cap that have huge impact on our benchmarks. Number 3, look for smaller names and individual opportunities. At a high level, sort of looking at the overall configuration, this definitely looks more like a down day than an up day, right? If you ignore Meta up, Amazon up, Apple and Nvidia up, they all had decent days. And others like Merck and Walmart and Eli Lilly and Broadcom, totally fair, they were up. But the average stock, it sort of was sort of neutral to down, right? I'm seeing plenty of red. I'm seeing a lot of the neutral color. That's a decent. I think that's a decent way of characterizing it. And I should mention, by the way, we are streaming on Facebook, on LinkedIn, on YouTube, on X. I appreciate wherever you're streaming from. Put questions in as they come up as we're going through the charts and going through the heat map here. At the end of the show, I'll make time to take a question or two before we wrap. And anything we don't get to, we'll put in the final bar mailbag. We're planning an all mailbag episode on Friday of this weekend. I'd love to answer one of your questions there if we don't get to it today. All right, so we talked about the overall configuration, kind of more negative than positive, and I would just say in general, on the right side of this visualization, some of the value sectors like industrials, financials are in the lower left, but kind of similar idea. Some of the defensive sectors like real estate, utilities, maybe healthcare, probably weaker than average as I'm looking at just the general color profile here. All right, number two, looking at the biggest names. I mentioned some of these ones obviously had pretty consistent, strong up days. Apple and Nvidia. Apple is one of those names like Meta that is actually pushing to new highs, right? It's these stocks that are actually pushing not just to resistance, but through resistance. If you're all bulled up on the S&P here, if you are confident that the S&P and the Nasdaq are just going to continue to go higher through December and then on into the first quarter for another raging bull market of 2025, and that is possible. I don't think it's likely, but it definitely is possible. And if that's where you're at, I think you need to be looking for the Metas of the world to break out. Encouraging sign today that Meta was able to close above 600. You want to see it sustain that breakout. You want other of these mega cap names to participate. You want to see Microsoft, Alphabet, Nvidia, which have not particularly been great here recently, starting to regain some of their mojo and continue that uptrend. And so that's, I think, a key thing to look at today. Not a bad day for some of at least some of those leading names, noting that Microsoft, Alphabet, both very much flat for the day here. Third item, looking for some outliers, and I'm just seeing spotty red colors in almost all of the 11 sectors. In the lower left, you see something like Aflac, which is a insurance name. Aflac's actually a concerning chart. I think I grabbed that to look at in the chart review, but kind of stalled out at 115 in October. And now this week, over the last week, has gone up to retest that level. Instead of breaking out Meta style, it's actually coming off of that level. Insurance has been a pretty impressive area of the market here, really into the fall. Now looking a little less so with charts like Aflac starting to break down a little bit. In something like healthcare, you see names like Moderna, and these are not, it's not a stock that's been in a particular position of strength, but really pushing to the downside. The reason why that stands out to me is the Hindenburg omen, which we probably won't talk much about today because there's no signal here yet. But we had the initial signal last week before. Now we're looking for that confirmation signal over the next couple of weeks. Part of that signal is over 2.5% of the NYSE members have to be making a new 52-week low. So you need teleflexes and charts like that actually making new 52-week lows to confirm that Hindenburg omen. So, not to share what you all should be cheering for, but if you're all bared up and you're looking for something like the Hindenburg omen to flash a major sell signal for the first time since the end of 2021, which worked pretty dang well, you need to see stocks making new 52-week lows, despite the fact that the S&P is holding up very well. Also noting some concerning developments on UPS and FedEx. Both of those were down pretty good today. I was taught years ago looking at those, shippers as a good indicator for overall environment. It sort of goes back to Charles Dow and Dow theory and thinking of, Dow Industrials, which are the producers of goods, the Dow Transports are the railroads, which are the distributors of goods. UPS and FedEx are kind of the modern day distributors of goods. Now, again, it's with an asterisk because, companies like Amazon really aren't reflected there. But, those stocks are not looking particularly great. And I was taught it's a much better sign when those names are doing well, because that tells you a lot of consumers are ordering a lot of stuff and they're getting delivered. So we'll see, right, as what sort of indicator that may be. All right, that's it for the heat map. Let's continue on and look at the chart review. As a reminder, I can see questions that are coming in. So put a question in there if it comes to mind as we're going through the charts, and I'll try to get to a couple before we wrap the live stream here. All right, looking at the daily chart of the S&P 500, today and yesterday were almost identical. If you look at the upper right corner of this chart, it almost looks like a typo kind of glitchy thing because they were almost identical days. We trade above 60.50. We kind of closed right around there. We traded down a little bit after a lower open, but overall kind of It's an day. That's my professional opinion. So overall, I would say everything we talked about yesterday is still very much in play. Primary trend is positive because we have a pattern of higher highs and higher lows. The S&P is above two upward sloping moving averages. That's a good thing. Our market trend model is bullish on all time frames. and it has been for most of 2024. So the trend is up, right? So at this point, you're looking for signs that the trend is no longer up. And the way you look for that are with divergences in momentum and breadth, in things breaking down, and instead of making higher lows, breaking down and failing to hold that higher low, which means for me, S&P above 5850 is probably still a pretty good chart. So that gives us room within the month of December to have some choppiness, to have some noise. But as long as we hold that, I'm going to tell you the conditions overall are still quite positive, at least from that high level review. Some glitchiness on stock charts with some of the survey data, just to let you know, but the name exposure index as of the end of last week was around 99%. It's currently showing around 91%. That's a stale print. It's actually up here just below 100%. And I will tell you that is really close to the concerning level, right? Over this red horizontal line at 100%, that's the red flag kind of, ooh, are we all too bullish, right? And when this survey is a weekly survey of money managers, right? Wealth managers, RIA types of investors, people that invest other people's money, and they're asked for their allocation to equities. And on average, it's around 75 to 80%, I would guess, based on reviewing the data at times. But over 100%, that means the average response is leveraged long, meaning, overexposed arguably to equities, right? They're so bullish, they're actually taking on additional leverage, additional risk to gain upside exposure. If you look on this chart and see when the blue histogram has gotten above the red horizontal line, it doesn't guarantee that we're at a major top, but I have often found that significant pullbacks usually start right after you have that euphoric level, because everyone's so bullish, they're putting as much exposure as they can into equities, and that's often the end of the move. Anecdotally, I mean, there was an article, I think on CNBC today, basically saying, has the narrative is the market's going up in December. It's very hard to find people not talking about the bullish, outlook in December, and the price targets I'm seeing for next year are outrageously strong and possible. I mean, they're not impossible. They're not unreachable. I would just argue some of those are unlikely, and they reflect a lot of optimism that I would argue is already priced into the markets. So you look for signs of euphoria. You look for signs that investors are too bullish. I would say the headline risk is definitely there, because I'm seeing a lot of people talking about a lot of upside. The positioning is what you look for. Look for the name exposure index above 100%. I'll keep an eye on that this week. I mentioned my interview with Russell Rhodes, who's now a professor at Indiana University at the Kelley School of Business, and great market experience, and a frequent author. His book on the VIX I thought was really well written. We talked a lot about that book, and I'll have that interview out for you hopefully later tonight after the show is over. But we talked a lot about the VIX. It just had me looking at a lot of VIX charts over the last couple days, and I would say that the volatility is fairly low, right, by any definition. Quick preview of one of the great takeaways that Russell shared with me. He said, I asked him what he looks for in this kind of environment when the market's so strong, when VIX comes down, like what's the warning sign? And he said, when the S&P and the VIX both start to go up, a lot of times toward the end, you'll have equities go higher on increased volatility. And that means there's uncertainty that's probably not reflected yet in the S&P, but is probably a concern. And so looking for an increase in the VIX as the S&P goes higher, he said, was one of those big warning signs to look for. I'll certainly be looking for that. All right, looking at some individual stocks here. Meta, as I mentioned, we talked about stocks trading not just to resistance, but through resistance. I think the bull case for the S&P and the Nasdaq going into the beginning of next year means Meta has to blow through 600 and go further. It did that today. That's impressive, right? Now, after you have a big breakout, particularly above an established resistance level, it's all about tomorrow. It's all about the follow through. One of two things can happen tomorrow. Number one, you see additional buyers coming in, not scared away by the expensive price tag on Meta and saying, I think Meta is going to go up another 50%. So I'm happy to buy it at 610, 615. On the other side, people might say, wow, Meta over 600, that is way overvalued. No way I'm touching that thing. And they start to short, or there's no buyers coming in. And all of a sudden we break above resistance for one day, and then we come right back down. That is the risk on this chart. I think the breakout on the surface is encouraging. It's all about follow through tomorrow now on the chart of Meta. Stocks like CF came up on my scan of stocks making new 3-month highs today. I like the action that I've seen in CF with some pullbacks to an ascending 50-day moving average. Here we kind of have a mini cup and handle kind of pattern. I don't know if it's a perfect one, but it looks similar. You have a resistance around 90, 90, 50. We finally broke above that this week today with a nice follow-through day, showing signs of strength. I like the improvement in relative strength as well. Cisco, kind of a similar vibe as well. I don't know if I would label this a particular pattern, but I would say getting above resistance is key. We've found resistance in the 78 to 79 region a number of times over the last 4 months. Today, we closed above it. Same thing goes as we talked about with Meta. Now I want to see follow through tomorrow. Cisco is kind of a defensive name. This isn't the technology Cisco. This is the food retailer kind of Cisco that makes stuff for cafeterias, right? That's SYY, a fairly defensive name, higher yielding name, but decent price action, something to watch. I often get questions about what to do with charts like Carvana. I have two charts I wanted to share with you, Carvana and Palantir, both in these established uptrends. And when people ask me about charts like this, I say a couple things. Number, is it too late? My answer is no, it's not too late. The market history is full of examples where you have stocks making new 52-week highs, and that's just the beginning, right? I mean, read any book by William O'Neill or look at Investors Business Daily at any given point, and they will gladly share with you names that are breaking out. And what you learn is that stocks that go up 1,000% first have to go up 50% or 10%, right? It has that initial breakout, and then things go higher. So, we often think things are too late because they've had a run, but remember that stocks can compound their gains, and it's happened many, many times. In this sort of environment, I don't think about price targets and say, all right, if it hits X, I'm going to take some off. For me, it's all about following the trend as long as possible. So stick with names that are working would be my second observation with something like Carvana. There are a lot of great technical tools to help you make sure you stay in trades as long as possible. It could be as simple as moving averages. It could be something like the chandelier exit system, which I'm a fan of. That's based on average to range. And so things like that help you stay in a trade as long as possible, but get out once the price really starts to deteriorate. That's what you want to kind of find. I would say the same thing with Palantir, right? It's up another 7% today. It's up quite a bit in 2024 on an adjusted basis. We started the year around, where are we here? At the end of last year, around $17. We're now up to 71. Not bad, right? Is it sustainable? I mean, no, at some point that trend will reverse, but it's not reversing today. And so, adding exposure to names that are working, it's kind of like watering your flowers and pulling your weeds. You don't want to water your weeds and pull your flowers. So you don't want to be pulling things that are working and then get them out of your portfolio so that your portfolio is full of the stuff that doesn't look as good. You want to be continuing to have exposure to names like this that are working, and then get out when the chart tells you not to be there anymore. On both of those two charts, I see uptrends. I don't see downtrends, so I'd be happy sticking with them as long as possible. Let's look at some of the names breaking down. Aflac finding resistance at 115. You look at the chart of Meta, impressive breakout. The opposite is what we're seeing here, a stock trading to resistance, but failing to trade through it. Now, it's still okay, and I would be focused on that November low, which is around 103 or so. If we can hold that, still isn't broken. But until this can get above 115, I think it's questionable at best. The divergence in momentum is probably the most concerning feature of that chart. Seagate Technologies, it's not really like a head and shoulders top. It kind of looks like one-ish. And it's not I would not label that. I don't think you can, because it's sort of a weird configuration, but certainly is making lower highs, certainly stalling out at the 50-day moving average, and now testing the 200-day. A stock like this that has had a pretty good run, but is starting to show some short-term weakness. I always want to see, is it able to hold that moving average support? And if it breaks the 200-day, if it gets below like 96, 95, 50, I think that's a pretty ugly chart all of a sudden. Speaking of ugliness, I would say that the semiconductors are it. The SMH is not looking particularly strong. It's not horrible, but not great. And I think the problem is underneath the hood. You have a lot of stocks that are in that group that are actually struggling. Here's Intel, which is a bit of an outlier. It's kind of a different chart than a lot of the other ones, different company than other ones in terms of their business model, but down another 6% today. That takes us below the 50-day moving average. After this really encouraging breakout in September, we're kind of finding support here, and now all of a sudden it starts to look different. The momentum is still okay, right? The RSI is at 40. We're not making a lower low, but I'm certainly feeling that this is a weaker sort of impulse move than a pullback. So I'd be watching that support around 21, 21.50 and see if that's able to hold here. Otherwise, Kind of an ugly chart. All right. Take some questions here, and I appreciate so much. I'm not going to show this one, but I am going to show this one. Hey, you put it on here. I can show it. Going to tell my wife after my next bad trading day that I had a differentiated return profile. You can quote me on that. Although I wish you the best with that one. Let's see. Next question. What's your daily routine? Zane, thanks for watching on the YouTube. What is your daily routine? So I actually have a number of things that I do every day. I will tell you what I at a high level what I do, and then part of my market misbehavior premium members, part of what I have shared with them, and what I will continue to hopefully do more of in the new year is sharing more about my daily, weekly, and monthly routines. They're super important to me, having consistent processes that I do. And I find when I get away from those routines, my market awareness goes down, my success rate goes down, my consistency goes down. So I found it's kind of like a diet, right? You can have cheat days occasionally, but overall, you really just want to stick with good nutritional habits. I want to stick with good awareness habits, market awareness habits. Having said that, what I do every morning is I look at the what I call the market misbehavior live chart list. I literally start every day. I call this the morning coffee routine because you get the cup of coffee, you fire up the laptop, and I start going. I start with this weekly chart of the S&P 500 that features my market trend model, because this is the first chart you look at during the day. I consider this a form of anchoring or priming, which is basically I want to think about the trading day within the context of a medium-term to long-term time frame. That's what I'm trying to do. I'm not trying to day trade. I don't really swing trade a whole lot. I'm looking more that next level up. I'm looking to follow trends and identify those. So for me, starting with this weekly chart of the S&P is important because it sort of helps me define, okay, before I look at anything else, let's just reset. Let's regroup on what are the trends in the market right now. The long-term, medium-term, and short-term trends are bullish. The market's going up. Okay, good. Now let's go on from there. Then look at a daily chart of the S&P 500. I'm usually looking at the market after the open. I usually look at the market for the first time around 6:30 or 7 a.m. Pacific time. So that's right after the U.S. Open. I don't do a lot at the open. I look to see what happened. And a lot of my day is geared more towards, toward the close or after the close. Because of the time zone I'm in, it's a much better lifestyle in my opinion. So I don't do much before the open. I don't do much at the open. I want to see how things open and then sort of follow the action through the rest of the day. And then I go through all these other things, just looking at performance, looking at things like Dow theory, interest rates, spreads, volatility, currencies, commodities, breadth conditions, sentiment conditions. And then I look at some sectors, and then I actually look at the market carpet to see what's going on in the markets today. A heat map visualization like this, I think, is just if I had one thing besides a chart of the S&P, I would look at this, because I think you can infer so much by just thinking about what's leading, what's working, what's not. Is everything up? Is everything down? Are there outliers? Are there groups of performance that you can start to draw conclusions from? And then I have this up. The stock charts monitor. I use other platforms like Koifin as well, depending on what I'm doing. And then I'm just looking for ideas. I'm looking for things that are moving, and I have alerts and monitors set up. It's kind of my normal daily routine. Now, I mean, professionally, what I do is a lot of interviews. I interview people, I get interviewed, and so I write a lot of articles. So my own daily structure during the trading day is sort of in a lot of different places, doing different stuff every day along that general theme. But in terms of a market routine, that was my quick summary about what I do every day. By the way, I don't want to tell you that is the right option for everybody. What's important to me is my routines are all set up to help me answer the questions that I'm trying to answer. So, don't ask me what my routine is thinking, all right, that should be my routine. Use my routine as inspiration to answer your own questions about, right, what's your investment horizon? What kind of markets are you looking at? What types of things are you trying to do as investment goals, and build your routines about helping you accomplish those goals consistently. That's what I would say. Rick, you mentioned the VIX discussion a couple times. Do you trade the VIX? Thanks for asking about that. And it actually came up in my conversation with Russell Rhodes about VIX futures, about ETNs, because there's a lot of ETNs or exchange traded products that are either linked to VIX futures or trying to play long or short volatility plays. I mean, occasionally I've made trades with those ETNs, short-term trades, more swing trade types of things. Generally speaking, I don't trade volatility directly. Talking with Russell, what a fascinating market. And the fact that you can be short volatility, that you can use it as a hedge to what you're seeing with equities, super interesting to me. But no, in practice, I really don't do anything with volatility. For me, the VIX is a market indicator. It's a way of assessing, sentiment, just like I would look at the put call ratio, which we also talked about in that podcast interview, looking at positioning data, like survey data, like the name exposure index, and painting a picture overall about where investors are at based on how they're answering some of those questions. Folks, that is it. I want to thank you so much for joining me here on the live market recap on Chart This with Dave Keller. I appreciate you so much following me and my work. I hope you find these reviews helpful. It really is a reflection of the charts that I'm observing, that I'm analyzing, that I'm sharing with clients and with others during the day. And I really appreciate your feedback all along here. Some of the questions were very, very good. I don't have time to get to them, but I will put them in the mailbag. Make sure you watch Friday's episode. We'll have a little more time to go through some of those thoughtful questions you guys have been sharing. For Market Misbehavior, I'm Dave Keller. Remember, it's always a good time to own good charts. Have a good night.